Welcome to today's seminar. My name is Douglas Arner. I'm the director of Hong Kong U's Asian Institute of International Financial Law. And I'm very pleased to have with us Dan Liebau. Dan is the founder of Lightbulb Capital, based in Singapore, and a frequent visiting professor at Singapore Management University, as well as Rotterdam School of Management, amongst other places. Dan, as some of you will know, is also one of the main lecturers in CFTE, the Center for Finance, Technology and Education's Foundation FinTech course, and a very active investor, advisor, speaker, writer, and teacher on fintech issues all over the world. So today, Dan is going to be talking about, I think, a topic that many of us are seeing increasingly in the markets, and where we're seeing some very, very rapid evolution and development. And that is security token offerings. Dan, over to you.
Thank you very much, Douglas, for having me today. And esteemed participants, thank you so much for dialing in today on a Friday afternoon. I really appreciate it. Let's get right into it. As Douglas mentioned, we want to talk a little bit about security token offerings today. And this work is basically a collaboration with my two co-authors, Thomas Lambert and Peter Roosenboom, both of Rotterdam School of Management at the Erasmus University in the Netherlands. And you know, the year 2020 couldn't end better, because we've got this interesting quote from Jay Clayton, the SEC chair, who basically said in this webinar recently that perhaps all stocks or securities might eventually become blockchain tokens. So you can imagine that created a whole wave in the industry and a lot of excitement. But what we want to do today really is look at the security token market in a more empirical basis. So while we've read a lot about initial coin offerings and the cryptocurrency markets, primary and secondary ones, there's much less written so far about security token offerings. So what do we do in our paper? Well, we discover some basic facts about this primary security token market. And we also start to explore a little bit what are the success factors that matter when one issues a security token and wants to raise some capital. Some of the key contributions of our paper, key findings, include the following. And the first one is actually quite relevant, so we're going to talk about it a little bit more in depth. Security token offerings are not initial coin offerings, or perhaps even a subset of these initial coin offerings. We also find that security token markets basically developed after the ICO bubble imploded. This was around the late 2018. In our paper, we show that the STO market is a nascent market, and that is obviously associated with a relatively low success rate. We find that STO issuers basically are geographically dispersed, but they do concentrate in jurisdictions where there is an accommodating securities law for these type of products. And finally, we see that security tokens are really a merger of perhaps more traditional corporate finance, but then at the same time, you know, they pick up some of the novel blockchain world. So when we looked at correlations between funding success and a number of independent variables, we note that good governance practices are basically relevant for funding success. But at the same time, things like transparency matter very much. So for example, whether you publish your source code of your smart contract on GitHub seems to be a relevant factor. I don't want to bore you with the literature review, and I also appreciate that most of the attendees today are probably from the industry or from the regulators or other entities. But basically, what we try to do is we try to cover the traditional corporate finance literature. You can see some relevant papers here on the right-hand side, and then also some of the more recent publications in the ICO and blockchain literature. And of course, we build on theory, but then we also look at the relevant empirical papers in the space. Now, I mentioned that we really differentiate between initial coin offerings and security tokens. And for that, many people have started to formulate this differentiation. But what I want to do briefly today for you is to really show how these three different types of tokens that many people talk about today, payment tokens, utility tokens, and security tokens, differ. And when we do so, we want to do that keeping the purpose of the token issuance in mind. So when we ask a question, what is critical to define any of these tokens, we want to think about why have they actually been issued? What is the purpose of the token? You're probably most familiar with the cryptocurrencies or payment tokens. We like to think that they are very equivalent to cash in our normal fiat world. But let me focus a little bit more on utility tokens and security tokens. So if you look at how utility tokens are defined, there's a very good paper on initial coin offerings by Howell et al. That also David Jermack co-authored. And we like the definition in there. It says a utility token is basically giving the holder a consumptive right to access a product or a service. That makes it somewhat similar to a voucher, if you like. So what is the purpose of this utility token? It's all about being able to spend this token in a community-based ecosystem, okay? That is the main use of a utility token. And if you were to put on an accounting hat, you would probably realize that a utility token is a funding mechanism, but it would probably show up under revenue on your income statement. And even if you categorized it as working capital, it is probably a short-term liability. How about security tokens? Well, security tokens are really a digital representation of an investment product. It is therefore a financing instrument for the issuer, but it's also an investment product, and therefore on the investor side is really bought with the expectation of a profit. And again, if you look at it from an accounting perspective, it will probably be found on the right-hand side of your balance sheet, right? Under equity or perhaps some other type of long-term liability. So I think this is a very important distinction to make, especially in a world where there is no global consensus amongst regulators about the nature of utility tokens and security tokens. So that is one contribution of our paper, where we look at a purpose-based categorization. I think something that we didn't mention. So I will keep this presentation relatively brief, but then I also want to allow for plenty of time for us to have a discussion. So if you have questions, then please let's discuss them after I present it, okay? All right, so next step, I wanted to briefly talk to you about the typical security token offering process. And that process is actually not too different from a traditional private placement or security token, security funding round. Basically, in the beginning, you have a lot of preparation where the core team gets together and irons out the economic viability of the opportunity, perhaps prepares a first investor deck, and also tries to identify who potential investors are. In the phase 2, we basically appoint corporate finance advisors and also legal support to make sure that you prepare for your offering properly. You also select the jurisdiction that you want to issue from. And then with help of your legal experts, you will probably prepare all of your offering documentation. That offering documentation typically also includes a term sheet. Phase 3 is perhaps a little bit different to traditional offerings, right? Because you're offering a security on a technology platform, you basically need to select a number of technology providers that can support you. That includes the critical decision of picking a blockchain. And we can probably talk about that in the Q&A section of this seminar more. But one blockchain doesn't equate another blockchain. And there are important features that you probably want to take into consideration if you issue a security on a blockchain. There are also other technology providers that help you go through KYC and AML type of processes. Perhaps also some others that help you to distribute your tokens to token holders at the right time. Since you're offering a regulated product, you will have to work with financial services providers as well. So appointing a broker for the sale of your securities makes sense in most jurisdictions that we have looked at. Sometimes transfer agents and custodians are also required. And eventually, if you want to collect fiat money and then distribute tokens for and accept basically fiat payments, you need a payment service provider. Then the main phase starts. Basically, capital raising works very similar to the traditional process. You basically try to identify a cornerstone or major investor that assists with positive signaling, and then the broker will basically help you and share his Rolodex so that the team can basically pitch to the relevant investors in his network. Of course, there are other online and offline marketing activities depending on the exact type of investor that you're targeting. But eventually, during this process, you will have found appropriate investors, and then they will sign offering documentation, wire you the funds, and then after confirmation, of course, they will receive their tokens in their respective blockchain wallets. Basically, that's it. That is what a primary market security token offering is. And the sixth phase that we have here on the slide is really quite optional. And that might be sounding a little bit surprising for those of you who come from a more of an initial coin offering market segment, because phase 6 is really about listing your token on an exchange. But I would argue at this stage that the main purpose of executing or going through a security token offering process is not necessarily the immediate listing. It's much more akin to traditional fundraising, where you basically try to get enough money to build your product, and then you make progress on your platform development, rather than to instantly move your token onto a secondary market. Nevertheless, if you choose to do so, there are obviously some steps to go through. So you have to select the exchange that you want to list your token on. Perhaps there's additional marketing that you have to go through. Eventually, you will partner with market makers to ensure that there is at least some liquidity. And liquidity is a big topic that I personally like to stay away from a little bit, because the big promise of massive liquidity in security tokens, we have not really found any empirical evidence for that. So I've seen many articles, many websites that suggest that security tokens are a great idea because you can then list your token and then there's instant liquidity. But we could not find any real empirical evidence for that yet. That doesn't mean that I don't believe that we will eventually see that going forward. Okay, let me talk a little bit about the sample construction. So we have identified around 280 potential security token offerings that we wanted to look at closer. After careful analysis, we realized 84 of them turned out to be initial coin offerings according to our definition that I had laid out to you before. 9 of them are stable coins. Stable coins, as you know, are a cash equivalent tied to a fiat value. So we didn't think with our entrepreneurial finance lens on that it would be good to include those, so we didn't. We found that 2 of the offerings were actually not issued on blockchain, but they were perhaps funds that invested in blockchain companies. So we removed those 2. We had to make a cut eventually. Perhaps in a next iteration of the paper, we might add some of those observations. But basically, we said we're going to look at all security token offerings that have been completed before December 31st, 2019. Yes, it took a while to write this paper. So now I'm sure there are more observations, but we had to take that cut eventually. Unfortunately, we lost another 52 observations out of the 280 because some key data points, like for example, the amount raised or the target amount, were not available. So basically, we are left with a small sample of 106 observations. And you know, for those of you who ask, you know, is this then even a relevant empirical study? We acknowledge that 106 is suboptimal, but we are also studying a nascent market. And we looked at many observations and really wanted to make sure that each observation actually qualifies for our analysis. All right, so I already talked about this briefly. We can clearly see on this chart that the main security token issuance activity started after the initial coin offering period ended, which was around late 2018. So that's an interesting insight. As we know from entrepreneurial literature, early stage ventures, and most of the observations in our sample are actually startup companies or early stage ventures. Most of them don't do so well. So we have about 60% of all of the projects that did not even manage to raise capital successfully. Here are some of the bigger names that you might have already seen in the media before. The biggest offering in our data set is a company called T0 that raised $134 million. I guess what I wanted to highlight on this slide is really that we do have mostly entrepreneurial firms on here, but we also do have some observations of companies that are very well established and large institutional players. So we've got one offering by Societe Generale, as you can see here, over $100 million as well. And then we do have Lottery.com in the US, which is also a relatively big company. If you were to look into the future, we now see a lot more institutional activity in this blockchain space. So I think just recently there's a offering by Olam, agricultural business, that basically issued or mirrored their offering, a bond offering of $400 million on blockchain together with Singapore Stock Exchange. So you can see how there are bigger companies that are entering this space now and trying to take advantage of the benefits of blockchain-based securities, if you like. Quickly wanted to show you some data about the main jurisdictions. So you can see that there is a concentration in these jurisdictions that I've highlighted here: Cayman Islands, Singapore, Switzerland, United Kingdom, of course, many offerings in the United States. But then otherwise it's quite a dispersed data set, if you like. And I think it's also quite normal in a nascent space. You will see that people try all sorts of different offerings for different reasons, right? Most of these jurisdictions that have some sort of regulation for security tokens or securities regulation that applies to security token offerings try to protect the retail investor. So what we often see is that retail investors are excluded from being able to buy into these offerings. And not in all jurisdictions, but in most jurisdictions, at least some sort of notification of the regulator is required if you launch a security token offering. In some regulations, of course, you need to ask for approval, but often a notification suffices. Perhaps another thing that I want to say briefly is, as you know, in the United States, the same Jay Clayton actually said that he hasn't really seen any initial coin offering that is not a security. That is obviously very contentious in the context of our paper, but what I wanted to highlight is that the 30% of offerings in our sample are all not utility tokens as per our definition, okay? So we really try to exclude initial coin offerings from our data set and really focus on the ones that are security tokens according to our definition. So things like, for example, the block stack offering, that was a very famous offering in the United States and was in the papers last week, because they have to now transition from a security to a utility token according to local regulation, would have not been included in our data set. Security token is not equal security token. So we do see that in our data set, we have different types of security tokens. We do have debt, we do have equity, we see funds being tokenized. We see also some more exotic derivative types, but not very many. And what is perhaps most interesting is that there is a large group of what we call income share tokens. About a third of them are income share tokens. Income share tokens basically promise the token holder a share of revenue or sales, depending on how they are structured. And that is perhaps a little bit more innovative way of structuring an investment product that is up and coming, as it seems, at least in the security token space. These are some of the variables that we looked at. So of course we split between dependent and independent variables, and then we have our 3 success variables: how much money has been raised, how much money has been raised compared to the objective, and then if there was one, has the soft cap been achieved. On the independent variable side, we look at investor rights or governance type of variables, for example, voting rights, dividend payments, non-dividend payments that would, for example, include coupon payments in the case of fixed income type products. And then we look at more relevant independent variables that are more, or perhaps more found in the initial coin offering space. So whether you disclose your source code on GitHub, also how long the offering was, do you have a Telegram channel, what is your team size? These are, if you read the ICO literature, these are variables that are quite common in this particular type of literature. Let me show you briefly a little bit of descriptive statistics. So we don't have to go through this line by line, but I already mentioned before, the limited number of observations basically suggests that the security token market is a nascent one. And what's also interesting is that you can see in this red square that I put out here lots of zeros, and we basically attribute that to a very high failure rate that we had also discussed earlier on in the presentation. This is our very basic model, or one of them. Of course, on the left-hand side, you have your dependent variable, in this case, amount raised. Then you have a constant. We do have the traditional governance type of variables, and then we also have the more blockchain focused variables in our equation. And then we have a error term. Nothing too fancy at this stage. Very simple, actually. What are some of the success factors then, you might ask, now that you have seen the model and the descriptive stats? Basically, we find 2 things that are interesting. So in line with corporate governance literature, we find that the giving of voting rights correlates with funding success. And that is interesting because if we assume that many of the offerings come from an ICO background, perhaps, then most issuers would have been inclined to give at least least number of rights to their token holders. And then counterintuitively, from their perspective, perhaps voting rights play a major role. That would also explain why so many issuances, didn't raise any capital. But we do also find confirmation of what we see in the ICO literature. For example, disclosing your smart contract on GitHub so that other people can review and that is transparent to the market how you structure that smart contract enters positively and significantly into our model. Another thing that I wanted to kind of go on a little bit is the marginal effect of giving voting rights to your investors. So if you held everything else constant, as you can see over here, voting rights basically have about 0.6 of an influence onto your funding success. So it's quite relative, and maybe is quite useful for those attendees here today that are considering to execute or to do a fundraising activity over the STO route. So in conclusion, few takeaways, right? STOs are not ICOs or utility tokens. Yes, it is a market that is in its infancy. At the same time, over the last 12 months or so, we have seen more institutional adoption. Larger corporations are exploring how to make use of security tokens. We also see more fund offerings. That's also an interesting development. We see some correlations between funding success and good governance. And we do believe that the next iteration, if you like, of securities on blockchain are not going to be mere representations of securities on blockchain, because that's the case today. For example, if you take Singapore as an example jurisdiction, you have a central register of a central company register, right? So for example, shareholders will be recorded centrally at a government entity level. So if there is a dispute and I have tokens, but somebody else's name is in that register as a shareholder, then I probably will lose to that other entity. So what is a very interesting development is what we call native digital securities, or NDS. And we define those as legally accepted primary record of securities that are created as a smart contract on a distributed ledger. And that basically means that if there was ever a dispute, the blockchain is effectively the one data source that supersedes any other records. And for that, obviously, regulatory changes need to happen in most jurisdictions. But there are some jurisdictions, for example, Liechtenstein, that has already come up with a blockchain act where this is indeed the case, and you can issue these NDS type products today. A few more things to share. We also have created a Chinese translation of the paper. That is one thing. And then I think the other thing I wanted to do is if I can pull up the chat. I'm sorry, I haven't really, let me see, where's the chat? Maybe when I unshare my document, I will post the link to the paper for those of you who want to perhaps look at it as well. So I'll share that. The paper has been covered quite a bit, actually. So we did create one related blog post on the Oxford Business Law blog, where we describe the key elements of the paper. There's another one at the Chinese University of Hong Kong where we talk a little bit more about this NDS construct. We've been featured in blockchain media as well, with an article in Cointelegraph. And just yesterday, I had the opportunity to briefly talk to the NASDAQ journalist about the paper. So quite a bit of traction, which is interesting. But certainly today is the highlight, because I saw how many people dialed up, and I am actually quite nervous because so many of you came today. So thank you for that. And with that, I guess we can move over to questions and answers. I have not looked yet at the Q&As, but I saw that there some came in. So why don't we look at the questions now?
Thanks a lot for that, Dan. That was really good. Maybe I'll take you through some of the questions to get things started. But actually, I wanted to start you with a question that I was curious about, but that also you mentioned, and that is in the context of your blockchain choices. Why different preferences? And of course, for those with a background from the standpoint of thinking about IPOs or traditional securities offerings, one of the big things you're going to be thinking about is venue or choice of law, et cetera. So I'd be interested in pros and cons of different blockchain options.
Sure. Okay. So we touch on this in the latter part of the paper a little bit, but also, we're writing a finance paper and not a computer science paper. So we had to limit that section a little bit, but I have some rather strong views on this. So as you know, financial market infrastructure places a big focus on the finality of transactions. I think there's relevant IOSCO papers or BIS papers on that, where basically the suggestion is that financial markets infrastructure should come with real-time finality wherever possible, and we're not something that is close to real-time. And there's a quite an interesting dynamic in blockchain world, where most of the blockchains that we see today operate on a probabilistic consensus algorithm. And that means that you have a period of time where the transaction is proposed, but until you have basically enough support from the validators, the transaction is not final. And that gives rise to several opportunities to basically tamper with that data. So what we are saying is, if you're doing a securities token offering, you probably want to think about whether you want to do that on a blockchain that has a probabilistic consensus algorithm. There are blockchains that use a deterministic consensus algorithm, where basically once the transaction as part of a block is mined, it is really immutable instantly, right? So we quite like that. There are probably some blockchains that do work on a probabilistic basis, but have put in some additional checks and balances on top of their algorithm, which is also acceptable. But this is a real risk. The second one that I briefly want to talk about is what we call fork risk. So you know how a public blockchain is an open system, where the community can basically decide how it's going to develop, right? And think about this, right? Think about you've just issued a 30-year bond. This is obviously an extreme example, but it brings out the point quite nicely. You issued a 30-year bond on a public blockchain, and suddenly the developer community thinks that the functionality that you need to make coupon payments is no longer required on their blockchain. And that proposal gets approved, and a minority of the community members basically support your point of view. It says, no, we need that. But actually that part of the fork, becomes a rather small, insignificant part of that basically becomes their own ecosystem, but rather small. And then the majority of the ecosystem continues on a platform that basically doesn't allow you to do coupon payments anymore. That's a bit of a problem, isn't it? So we favor blockchain platforms where fork risk is at least, where basically community is aware of fork risk, and where there is some sort of governance implemented around this issue of how forks are being dealt with. Yeah, so those are the two examples for today, perhaps that are quite relevant. So the type of consensus algorithm, but then also how do you deal with fork risks?
In the context of looking at your types of STOs, what differences do you see between, say, an STO and a traditional security?
Sure. Because I'm not swimming with the crowd and saying, wow, there's instant liquidity, obviously I have to have other reasons why I think offering securities on a blockchain are a good idea, right? And perhaps I can give a few examples. So one is, if you think about the private equity fund space, you will be very familiar with the fact that there's loads and loads and loads and loads of paperwork, right? And often the transfer of a fund unit, private equity fund unit, from one investor to the next is hugely challenging because, you know, so much documentation, and it's quite tedious to go through that process. So if your fund units are stored on a blockchain, the transfer of ownership becomes as easy as signing a transaction on blockchain. Then the issuer smart contract will basically reallocate the units to the new owner, assuming that the blockchain supports, you know, digital ID and so on. But there are projects like, for example, Polymesh that are working on that and trying to build a end-to-end blockchain solution for security token offerings. So this ease of transferability is interesting. I think there's also something to be said about perhaps being able to more easily unbundle the firm. So if I'm looking forward a little bit, right now, if we look at a company, it's basically a collection of different types of assets, and perhaps with securities on blockchain, companies could start to fund individual projects that they want to engage in and raise raise money from individual investors that support only this one project, right? So while this is very doable today as well, it's perhaps a lot easier if you do it on a blockchain because you have the opportunity to transfer these units more easily. The other thing that I want to highlight, and that's perhaps where I should stop, is it opens up potentially a new group of investors, right? So while today we have you know, the typical investment type companies, venture capital firms, private equity firms, in the future we might see that securities can be offered to perhaps young, very technology savvy investors that are today not able to get exposure to these type of instruments. Of course, there is a whole conversation about accredited investors, and every jurisdiction manages that a little bit differently. But I think if we look at the more forward-looking jurisdictions, then you can see how they also try to be more inclusive. And even in the US, we saw recently quite an encouraging update that the accredited investor definition has been widened a little bit to include people who have Series 7 exam and so on. So eventually it becomes more important whether you understand the product rather than whether you can afford to lose the money that you put into these kind of investments.
Yeah, I think that's good. And I wanted to go on two things that are related to that. One is this idea that you mentioned, the relationship between the security token and an underlying securities register. You know, from the standpoint of the securities token tie to that underlying register, what sorts of structures are you seeing?
So there are three types of structures I think that we see today. So the one that is least conducive to security token offerings is the one that I mentioned earlier, right? Where you have a government-owned database of shareholders and companies, and where effectively your security token issuance needs a bit of a wrapper so that the changes in the government register don't really happen all that often, right? So transferability is really complicated in this setup. And that's why I think this is probably the type of model that will eventually fade away. The second model that we see is the one that Switzerland has implemented, and that offers a lot more flexibility. So in Switzerland, companies are entitled to maintain their share register themselves. So they have the opportunity to then pick a blockchain-based solution to maintain that share register. And that makes the security token issuance and also transferability throughout the life cycle of the security a lot easier. And then you have the third case that is, I already mentioned, is the one that is more close to the events in Liechtenstein, where in Liechtenstein, basically the blockchain supersedes any other records, right? And there are detailed requirements of entities that are allowed to make updates to these blockchain-based registers. But that is obviously the more purest type of a solution, because eventually you have all of the data that is relevant on blockchain in an immutable fashion. So it's also closer to the ideology of what a blockchain really is.
Yeah, I agree with you. I think that is really the transformative potential. It's going to be interesting, I guess, in the EU. There's now the proposal for the DLT infrastructure regulation, and that could provide us an interesting way forward. I wanted to take you back because there are a couple of questions on it to something that you had mentioned earlier, and that
Sure.
was around liquidity. I think what you said and what many of us have said is that the structure provides the potential for liquidity, but I wanted to, so you're saying, I guess at this stage, you're not really seeing that developing. And are you seeing anything with transactions that does seem to be impacting positively on liquidity?
Okay, so let's start from our little analysis that we also described in the paper. We said, if we can find liquidity, we're probably gonna find it in the biggest offering. So we went back to the T0 offering that effectively listed their own security token on their securities token exchange. That is as a ATS license in the US. And from the moment of listing all the way to when we wrote the paper, that token basically traded $10,000, under $10,000 a day, or over a 24-hour period, because the exchange doesn't close. And if you had bought, I don't know, $50,000 worth of that token, not only will you struggle to unwind your position, you will also do it in a fashion where you impact the market price, right? So then we cannot really talk about liquid markets if the biggest offering trades so little. I do know that after we have finished our paper, there were indeed days where the volume in this particular security spiked to, I think, around $250,000 per day. So that's interesting, but it's a little bit too early to say how stable this is, right? And remember that this is the biggest offering, right? So the other ones might not be as liquid either. So that's kind of our empirical finding. How do I look at liquidity going forward? Well, I believe that the main opportunity for securities issued on blockchain are actually not related to entrepreneurial finance or startup funding. And I do say that because I think that the main objective of an early stage startup should really be to build their product and then focus on making sure that they have customers and then kind of grow that way. If a company that has 3 to 5 employees suddenly becomes a public company, because that's effectively what they are when they list their token on an exchange, they need at least a full-time person that does investor relations, right? Because suddenly you have this large group of investors who have an interest in your company, whether they have rights or no rights. They're really interested in knowing what's going on in your little company. And I think that can be quite distracting. So in my mind, if you're early stage startup, perhaps don't do an STO. But where security tokens become a lot more interesting, and this kind of ties it back to the real liquidity opportunity in my view, is for larger corporates, right? Can larger companies, public ones and private ones, not issue securities on blockchain and then perhaps benefit from some of the things that we discussed earlier, right? Whether it's more in the project finance kind of space, where you can get creative about how to structure securities for particular purposes, but also for reaching out to other investors that you are perhaps that you don't have on your that are not part of your community. Another interesting thing that we discussed more recently with my co-authors is, can security tokens be a tool to engage your shareholders more? Because if you have a smart contract that basically entitles you to voting rights, you could do away with offline type of shareholder meetings where there are like 5 proxies in the room, and you could perhaps try to use your security token to engage more. Now, some management teams might like that, and some management teams might say, actually, we don't want that. We like it the way it is, right? But it can go even further. And if you're a little bit more creative, you can perhaps bake in utility token type features into your securities, right? And if you look at, for example, I don't know, very basic example, right? But if you are Starbucks and you want a really strong tie to your shareholder base, you can ask them to vote on a website, and then that website links to the smart contract. But also, you can give them a 10% discount on the coffee they buy, right? Just to build that relationship and to make that bond stronger. So there are lots of opportunities, especially if we are a little bit more creative in the future.
Yeah, a couple of questions that picking up. If I guess when you're defining the jurisdiction, you're basically defining the jurisdiction of the offering, because in most cases these are registered or notified. Are you usually seeing, I guess, from what you've been saying, you're seeing, I guess, generally corporate entities. Are you seeing a sort of match between the corporate entities and the jurisdiction, or did you look at whether there were differences between those?
Okay, so that is a very good question, and it's actually a very complicated topic. Because, and you will know this because you know regulation much more than I do, but you basically have to understand the incorporation of the issuing entity. That is the first step, right? And that is arguably perhaps the easiest one to find out as well. But then it's interesting because these tokens that the issuer gives out will then have to be placed with an investor base. And that investor base can include investors that are not in the jurisdiction where you are incorporated, but they can also be from that jurisdiction. So when you think about the regulation, securities regulation, you obviously have to take into account the securities regulation of the country that you're selling into. And that's when it becomes really interesting, right? So we've seen various constructs, including some where the company that basically issued the tokens sold them all to an offshore-based entity. And then from the offshore-based entity, the team distributed the tokens further to the eventual investors, right? So that so it quickly gets quite complex. And when we did our research, we tried to obviously gather as many offering documents as we could. And then we tried to disentangle all of this. It was quite interesting to learn how the different structures, global structures work, right? And there's no consensus about this is how you do it. It's too early for that.
Thanks, and that's actually takes me to something else that you highlighted that I was curious about. We've talked about the process. We've talked about the blockchain. We've talked about the jurisdictions. We've talked about the products. But what is the advisor space looking like? In other words, what sorts of advisors are we seeing working on these? And do you have any information on the sort of costs that are involved in addition to time?
Yeah, so there are different types of advisors, right? So there are advisors that are advising your company on, for example, your business model, right? But I'm assuming that those are not the ones that you're talking about right now. But there are also, and this is actually very common in traditional securities business, you have corporate finance advisors, right? And I think in Hong Kong, for example, there's a particular type of SFC license. I don't know which type it is, but there's a type for corporate finance. In Singapore, similar, you have a CMS license for corporate finance. So these companies are basically specialists in helping you structuring your offering, right? And arguably, because we have seen so few securities token offerings, there are not many companies that are specialists and that understand the success factors. And then that's perhaps where our little contribution stands as well. You know, we try to understand a little bit better, how do you structure these type of offerings so that you can attract interest from the investor community.
Yeah, that's interesting. And it's interesting, I think, to see how it's been evolving, because, of course, with many of the traditional financial institutions having been largely excluded from the market because of regulatory concerns, you had some different approaches. We've got a question here that I'm going to read out a bit, but then I'll sort of focus it in.
Sure.
Swiss 6 Digital Exchange is actively exploring a combination of STO, CBDC, and smart contract on its digital asset platform. What do you think of this exploration? Is the integration of STO plus CBDC plus smart contract the future trend of the digital asset sector? In other words, I think an interesting one is, what do you see the relationship between, say, STOs and CBDCs?
Sure. So a brilliant question, by the way, because often we get carried away with our tokens, but then we forget that somehow we have to pay for our securities too, right? So I really like the question. What I would say is that right now, most of these offerings probably make use of some type of stable coin, or when you actually have this true blue STO type of offering, there will be additional paperwork involved. You can pay in cash, you use a payment type of company, and then your tokens get allocated to your wallet manually, right? So that's obviously the kind of very basic way of doing it, and not a very nice way. So if there was a jurisdiction where there is a CBDC, then I think it would be a very good idea that digital securities offered in a particular jurisdiction, or perhaps even listed on a particular exchange, settle in the CBDC of the country, right? That makes a lot of sense. CBDC space, I'm not an expert in CBDC, but I think it might take a little moment outside of China for different jurisdictions to come to grips with it. I think in the meantime, we will probably see more offerings that make use of stable coins, because stable coins can interact with smart contracts today, right? And it's quite encouraging to see that many stablecoin ventures have expanded their blockchain portfolio, if you like. So while perhaps everything started up on Ethereum, and Ethereum is one of those with probabilistic consensus algorithm, there's lots of reasons why perhaps you shouldn't do an STO on Ethereum. Now you can do the same thing on Algorand or some other blockchain, and there is this cash equivalent, right? But I think in fundamentally is a really smart idea, if in your country there is a CBDC, that you interface with it, right? If that's possible, especially if we're talking about a regulated market like the securities market.
Yeah, I mean, certainly for me, I think that's one of the biggest potentials, is basically bringing together transactions and payments, which has been a long-term process.
Yes.
Problem in traditional finance. And it's interesting, we co-authors and mine have recently suggested in a paper that basically we are suggesting that one of the reasons for the evolution of stablecoins is because people want something that can tie essentially that payment mechanism to a fiat currency in the real market, because many of the traditional cryptocurrencies have proven really too volatile or otherwise for that sort of function. So it's very interesting. I think one last question,
sure,
and that is in terms of jurisdictions in Asia. what are you seeing in terms of regulatory trends towards STOs?
Yeah, very, very good question. And what I would say is, you know, what I say today might be outdated tomorrow, right? Because everything moves so swiftly. But effectively, what we've seen so far is that some regulators take the following stance, and they say, if you issue a security, then we have a securities law for you, and please adhere to it. And whether you issue that security on blockchain or not, it's none of our business. But there is securities law, and that's what you have to follow. Okay. So even in Europe, apart from, I think, the custodial side of things, this digital asset infrastructure, for example, that you mentioned, Douglas, earlier, is largely excluding securities on blockchain. It's more for cryptocurrencies and also utility type tokens, right? So that's one approach. But it's perhaps not the best one. Why? Because we do now see new players come into this equation, right? So you have, for example, these corporate finance advisors that are very savvy when it comes to blockchain topics. They can help you out with that. So one of the things that I think Singapore, as usual, does very well is look forward and try to think about how will we regulate activities that are related to digital assets overall, right? So recently they've published a consultation paper on what we call the Omnibus Act, where you suddenly realize that all of the functions effectively that are covered by the CMS licensing regime today might also apply to digital assets in the future, right? And that goes across securities on blockchain, but also the utility token space. So this is another way to approach it, and I think both are viable. And I think what is actually quite good about those jurisdictions who say just follow our securities law is that you don't have a regulatory dependency in that sense, but you actually know which rules you have to follow. You know, if you're marketing your security, then this is how you do it. And then if you need a broker, then you have to get a broker, and there's a list of them, you know. So this often helps and is perhaps much easier than in what we saw in the utility token space, where it was so brand new that nobody really knew what to do, right?
Yeah, I think that's exactly right. And it's something that, if we look at your survey in terms of the numbers for the US, that at some point, it's actually just easier to deal with the securities regime that you're used
Correct.
to the system, and you might as well just do it to make it easier from the standpoint of investors. Obviously, lots more we could talk about, and I wish we could all sort of applaud. It's one of the worst things I think about the online environment is applause just doesn't really work, and you don't really get to see a sea of sort of faces out in front of you.
That's true. We can wave though. We can wave.
Exactly. But Dan, thanks a lot. Great presentation. Great to talk to you, and look forward to seeing you here or in Singapore sometime in 2021.
I hope so. Thank you, Douglas, for hosting me today. And thank you, everyone, for your great questions and making some time on Friday afternoon. Thank you so much. Bye-bye.